Hello guys, so as on today, we witnessed something called as a bear flattening of the yield curve, right? So we have different types of yield curve strategies, but as of today, as on 23rd March 2026 in India, we witnessed something called as a bear flattening of the yield curve. So what basically happens in the bear flattening of the yield curve, the yields tend to rise, but the shorter term tenure yield, that tends to rise much more faster vis-a-vis the longer tenure bond yields. Here, what do I mean by shorter tenure bond yield? By shorter tenure bond yield, I simply means the yield commanded upon short-dated government securities, the risk-free securities, that is a one-year bond yield or a two-year bond yield. Whereas, if I talk about a long-dated bond yield, I simply mean a 10-year bond yield. Why a 10-year bond yield? Why do I take into account a 10-year bond yield and compare the same with a one-year bond yield or a two-year bond yield? Because a 10-year bond is most actively traded in the securities market. It has the highest liquidity amongst all category of bonds in the longer term tenure category. It also tends to price in the expectations for long-term growth, for long-term inflation, and also long-term BOP deficits or fiscal deficits, if any. It's attempting to price in the long-term risk in the economy. So as on today, on 23rd March 2026, we witnessed something called as a bear flattening of the yield curve, where the shorter tenure bond yields rose much more faster vis-a-vis the longer tenure bond yields. Just to give you a classic example. So as on today, we see, as on this screen, the longer tenure bond yield, it currently stands at 6.83%, risen by 1.51% in one single day. Let's come back to the one-year bond yield and a two-year bond yield. The one-year bond yield, it simply rose by 1.09% as on today, and it currently stands at 5.72%. But if we talk about the two-year bond yield, this two-year bond yield has risen by a whopping 3.71% in one single day and currently stands at 6.2%. It clearly highlights the shorter tenure bond yields have significantly risen much more faster vis-a-vis the longer tenure bond yields. This situation is simply categorized as a stagflationary economy, or the risk of stagflation in the Indian economy. Stagflation simply means high inflation coupled with low growth, or expectation of high inflation coupled with low growth. To come back, usually the shorter tenure bond yields are usually anchored around the policy rates. The policy rates to be set up or already being set up by the central bank of a country, RBI, the Reserve Bank of India in our case. So as of now, we are currently expecting a rise in the interest rates in the economy due to higher translating inflation. The major reason is the geopolitical tensions. So we can currently see US in war with Iran. Our net importing bill is expected to rise, or which has already risen. We have been a net importer of oil, LPG, and LNG being the natural gas, and a certain set of commodities like aluminium throughout. When the prices of these commodities rises due to supply constraints or the geopolitical tensions, the inflation tends to rise. Our import bill tends to rise. And this is being anchored around the short-term policy expectations. And that is the reason that earlier we were expecting a cut down in the repo rate, but now we expect the increase in the repo rate because inflation is expected to rise in a short-term or a medium-term basis. But if we talk about the longer end of the yield curve or the longer tenure bond yield, the 10-year bond yield, it usually tends to price in the long-term expectations for growth, inflation, BOP deficit, or fiscal account deficit, if any. And here we can see that due to these geopolitical tensions, the long-term inflation is again expected to rise, the growth is again expected to fall, the current account deficit is again expected to widen, which will again widen the BOP, the balance of payments deficit, which is a component of the current account plus the capital account. I'll give you one more point. A rise in a $10 per barrel for oil, it impacts the GDP. It cut down the GDP by 0.5% over a quarterly basis, increases inflation by similarly 0.5 percentage, and has a two-third of a percentage impact upon the current account deficit as well. But if it rises by much more than $10 per barrel, as we can see right now, and if the same sustains for over 2 months or so, the impact can be much more harder. And that is the reason we are currently facing a risk of stagflation, that is lower growth and high inflation. And that is why, as on today, the yield curve became a bear flattening yield curve. With the shorter term yield tend or rose much more faster vis-a-vis the longer term bond yield. Thank you so much.